Hello everyone, let us continue with our discussion. In the previous lecture, we have finished our forecasting for the equity. Clear? So the major portion of the topic we have already finished. Now we are left with just three portion and they are very quick to be finished. That is your real estate, then we will have currency and the last one is your volatility. Clear? This is what we need to forecast. Now we will begin with the real estate. Okay, we have to forecast the real estate returns. Now real estate is something unique, okay, that what we have understood till now, like they cannot be moved from one place to another place. They are very illiquid in nature. They are heterogeneous, means each property is unique from each other. They require continuous maintenance, so high operating cost is also there, and return are often based on the appraisals, means based on the time lag, but you will see that the return will increase on your land properties. So now the basic points, the key characteristics of the real estate is done. Okay, now when we are moving towards the real estate cycle, see, asset class is quite general in nature, and there is one thing that we know, that the supply is limited. Okay, supply is fixed at a given point of time. Clear? So property values generally exhibit the cyclicality. Okay, means like this. Okay, and demand is strongly influenced by what type of the property is. Clear? And the quality of the property, location of the property. Clear? One thing which is very important is that what is close to your property. Clear? If it is a very good mall, the value of your property is high, but if suppose there is a small garbage shop, the value of your property will decrease. Clear? So now there are two types of property: high value properties and low value properties. So if my property is of high value, then there are very less chances that it will fluctuate with the business cycle, because we all know that this is a good property. So even during the recession, suppose right now the price of the property is $1,000. Clear? During the recession, you can hardly get it for $950 or maximum $900, because you know that this property is gold. Okay, and it holds value. So if not today, then definitely after 1 year or 2 years, definitely this property will again regain the value of $1,100 or $1,200 when the market is at boom. Now on the other hand, if I'll compare a good property versus a bad property, okay, or you can say low quality property, so they are more cyclical. Okay, you will see the price variability in these stocks is higher, sorry, in these real estate properties are higher. Clear? So it's all about the level of confidence in that property. If the level of confidence is high, then it will not lose value even during the recession. Clear? But if the confidence level on that property is low, then what will happen during the recession? People tends to sell under pressure, knowingly what if the value of the property will come down to half. Who knows? Are you clear with this? So now we have two studies, a boom phase and a bust phase. So during the period of boom, okay, expansion, you will see that there is a demand will increase, and hence the price will also increase, and hence the lease rate or the rentals will also increase on the property. Clear? Now if the demand will increase, what builders are going to do? They will produce more units, they will start building more flats, they will start selling it, they will build more malls. Clear? More societies, and hence the construction activity will increase, and that will increase the economic activities, because you are purchasing the steel, you are purchasing the cements, you are purchasing the whole lots of material, you are giving the job opportunities, everything is coming, and hence the economy is reviving during the boom phase. Clear? Now what will happen during the recession? Opposite, demand will fall. Now we have overcapacity, many units are unsold, and hence the price as well as the lease rate will also start falling. Clear? And the long term lease, they slow down the adjustment because of the oversupply. Clear? Because the unit which is available in the market, it's not getting sold, and hence gradually the builders have to sell their units because they need the hard cash. So they keep on selling even at a lower price. Now we have also observed that in 2008 financial crisis was in the US commercial real estate, and that collapsed. Clear? Now that the reason of the collapse was heavy borrowing, speculation. So it's not about the normal business cycle which leads to the fall in the real estate of US. It because of the heavy borrowing, it because of the speculators enter into the real estate market. Now, let us continue with our discussion on a very important concept which is used in the real estate investing and the commercial property valuation. That is your capitalize rate or capitalization rate or the cap rate. Clear? So now, if you'll ask me, sir, what is the meaning of this cap rate? The term this cap rate, what does this mean? So this is nothing but what is your operating income from that property and what is the property value. Clear? Suppose the value of the property is $100 and you are earning $10 from that particular property. Clear? I call this as cap rate. How much? 10%. Clear? Now when I'm saying this net operating income, this is equals to your rent received minus your operating expenses, clear? Operating expenses like your maintenance, repair, property tax, staff salary, etc. It does not include the loan interest. Clear? So now you understood what is cap rate. Clear? Suppose you buy a commercial shop and that commercial shop is worth rupees 2 crores. Okay. That is the value of the property. Now that particular shop is generating you net operating income is of 12 lakhs. Then what is my cap rate? The cap rate is 6%. Clear? Because 12 lakhs divided by 2 crores, multiply it with 100, hence you are going to get 6%. Now what is the meaning of this 6%? Write down the meaning of 6%. Every 100 rupees invested in the property, is giving you rupees 6 earnings, earning per year. So this actually helps the investors to compare between the properties. Means there are A, B and C. All three properties are quite different. One is of 2 crores, one is of 4 crore, one is of 6 crore. Which one you prefer? Okay, I'll go with the 2 CR property. But the point is that this is giving you 12 lakh annual income. Clear? Now this property B is giving you the annual income of say 20 lakhs. Clear? And this particular property is giving you the annual income of say 28 lakhs. Now tell me, now you'll see that okay, 28 is also big, 6 is also big. Now how you will compare which one to pick? So now you will compare the return cap rate. Over here it's the highest of 6%. Hence you will choose a property A. Clear? Now this is something similar to your Gordon growth model. Okay, where you are comparing your dividend yield plus dividend growth, because cap rate is also similar to the denominator of the Gordon growth model which you are using in the equity valuation. Because over here if I'm earning the 12 lakh this year, definitely next year if the growth is 10%, I will earn more than 12 lakhs. My income will be 13 lakh and hence my income keeps on increasing every year. So expected return, if you'll ask me, sir, what is expected return? Definitely it is the dividend yield plus, so there is a growth of dividend yield. That is also my income, because for the future I also need to consider the growth on this dividend, that is also my income. So dividend yield is equals to net operating income. Similarly, we have the growth rate for net operating income. Clear? Because rent will keep on growing. Rent will keep on growing, but property value, once you have purchased, it's finite. You cannot say that property value is increasing. So in this formula, NOI divided by purchase value. Purchase value is fixed. NOI is increasing every year. Constant growth model. Gordon growth model. You remember? Okay. So now we have done two things. One, what is cap rate, and how to incorporate the Gordon growth model. Clear? Now, what is the new cap rate? What is the new cap rate? Is it only NOI? No, NOI minus the NOI growth. Clear? So if investor expect 8% return and NOI growth rate is 2%, what is cap rate? 6%. Same as earlier. Just now I have given you this example of 12 lakhs. Clear? So if I'm expecting that return is of 8%, NOI growth rate is 2%. So right now at present, am I getting 6%? The answer is yes. Next year, my growth rate will be 2%. So next year, what is my return? 8%. Clear? So my expected rate of growth next year is 8%. This year I am getting 6%. 2% is the growth rate. Clear? So NOI growth is coming from NOI growth coming from real growth of the economy plus inflation. See, all things are intact and all things are interconnected to each other. Real growth, that means more shops, more customers, more business. Inflation means rent increases because the price increases. So cap rate indirectly depends upon the inflation as well as the economic growth. Clear? Now, this growth rate and the property value, they are coming to you every year. But if suppose I'm an investor and I don't want to hold the property forever, I want that I will hold it for a limited time period. Now my formula will change little bit. If my holding period will change from forever to limited, my expected return is equals to NOI growth rate minus change in cap rate. So if the cap rate is expected to increase in the future because of the higher interest rate or because of the higher vacancies, so future selling price will become lower and hence it will reduce your returns. See, because when you will not hold the property for forever, that means you are going to sell. Now, if my assumption is that if the interest rates are going to be high, then the value of the property will reduce because interest rate are working as a discount rate. Higher the discount rate, lower the value of the asset. Clear? In that situation, my future selling price will become lower and that will reduce my expected return. Clear? So net operating income growth rate minus the change in the cap rate. Clear? One thing over here, what I missed is to add the cap rate. Okay, because cap rate plus net operating income growth rate is a normal formula, but because of the change in the interest rate can impact my value of the property, I need to reduce the change in the cap rate. Clear? So expected return is equals to your cap rate plus net operating income growth rate minus the change in the cap rate. Clear? This portion is actually saying that the reduction in the value of the property when you have to sell the property. Clear? So cap rate are very sensitive to the competition. Competition means how many similar properties are available in the market. Like if online shopping will increase after Amazon and Flipkart etc., then physical malls will become less profitable because people are doing shopping online a lot. Clear? Hence, you will see that malls are low productive. Clear? And hence their cap rate will become in rise. Okay, the cap rate will be higher, they will be more risky and hence lower value. Because if you'll ask me, between 2008 to 2018 the difference in the cap rate become between the high productive malls versus the low productive mall increase from 1.2% to 3.2%. That means poor malls become more risky and investor demanded higher returns in the poor malls, because the chances that the value of my property will reduce. Clear? Let us just check all the points in the notes one by one. This is done. Cap rate is similar to the discount rate. Long run NOI growth is equals to the long run GDP growth. Finite holding adjustment, expected return minus change in cap rate, because expected return is coming from cap rate cap rate plus net operating income growth rate. Clear? So from this, if you'll minus the change in cap rate, you will get the new expected return for the finite holding period. Clear? Now these cap rates are very much similar to the interest rate, or you can say they are positively correlated. So if interest rate will goes up, cap rate will increase, and if interest rate will come down, cap rate will also decrease. Like when interest rate rises, the borrowing becomes costly, property value falls, and hence the cap rate is also going to rise. Similarly, the cap rate and vacancy rate, okay, they are also similar. Like higher vacancy means higher risk means higher cap rate. Similarly, lower vacancy, low risk means low cap rate. Like if 40% of the shops in a mall are empty, then investors will demand a higher return because income is risky. Clear? So interest rates done versus the vacancy is also done. Now the availability, like when banks are reluctant to give you the loan, okay, very tight credit conditions, it become very difficult to buy the property. Property prices will fall and hence the cap rate will also increase. So if the credit availability is less, okay, cap rate is high. If credit availability is very easy, cap rate is low, because less risk means lesser cap rate. Clear? Write down. Credit spreads are counter cyclical. Credit spreads are counter cyclical means credit spread will increase when the economy is weak. Clear? So credit spread increased, that means high credit spreads, they will help to reduce the sharply cap rate to move with the economic cycle. Means it tries to say that when the economy is bad, credit spread widens. It is for sure, but that widening of the credit spread sometimes helps to stabilize the cap rate. So the point is that over here, when the credit spread will increase, definitely the cap will also increase, but not that much. Write one example. When the economy is good, when the economy is good, the government bonds are giving you 4%, corporate bonds giving you 5%. So what is the credit spread? 1%. Clear? And the real estate cap rate is say 6%. This is when the economy is good. When the economy is bad, means these are observed. Okay, so when the economy was bad, government rates 2%, they have reduced the rate. Corporate bonds still at 5%, credit spread is 3%, and real estate cap rate is 6.5%. So you can see that over here jump is of 2% in the credit spread but 0.5% in the cap rate. So even though the economy was weak, cap rate do not jump from say 6 to 9 or 6 to 8. Clear? The only slight increase is from 6 to 6.5% because the risky bond yield already increased a lot. Clear? So real estate pricing adjusts very slowly versus the bond or the equity market. So it shows that I am not very volatile. I means I am real estate and I am not very volatile when I am compared with the equity or when I am compared with the bond market. They show the immediate effect with a spike, but I am not that volatile. Okay, so I will take time to adjust that particular shock. Like during the 2008 financial crisis, stock market fell down by 40% in a gap of 2-3 days, but property value in just 2-3 days decreased by 10 to 15%. Gradually it went down but not immediate. So it was a slow process. So real estate pricing adjusts slower and hence making the cap rate less volatile when it is compared to the bonds and equity market. Now, when I'm talking about the risk premium in the real estate, like bond, we have multiple risk. Okay, credit risk, liquidity risk, okay, operational risk, a lot many risk. Clear? For the banks and for the financial institutions. But when I'm talking about the real estate, okay, for them the major risk is the liquidity risk. Clear? Credit premium is a very small portion that whether your tenant will pay the interest or not. It's a very small component. Okay, so it will not that big. But which one is very big is your liquidity risk premium, because it's very hard to sell your asset very quickly. Very hard. Means your asset is of $1,200 and now immediately you have to sell the asset. Trust me, you will be able to recover say $1,000 or $900 knowingly that it's very hard to get the money. Clear? So it's very hard to sell your asset quickly. So liquidity risk premium is the highest when we talk about the real estate. Clear? So risk premium is I need extra because I'm investing into the asset which is risky because we have liquidity risk. Clear? Though it also consider your term premium, it also consider your credit premium, equity risk premium, as well as the liquidity premium. So when I'm saying term premium means extra return because I'm investing in a long term assets. Okay, and real estate generally are very long term, like 10 years, 20 years, 30 years. Like if I'll tell you about my grandfather, they have hold a property from last 70 years. They're living on the same property from the last 70 years. The shop which they have given on the rent, it is again from the last 45 years. So if you buy a commercial property today, you cannot sell it next month easily. It's very hard. Means it's very hard to find a buyer as well. Clear? So you expect some extra return because your money get blocked for many years. Future is uncertain. Rent keeps on changing. Tenants may change. Future property price is also unknown. Clear? So you will charge a term premium because you are investing for a long term. Clear? Coming to the second one, that is your credit premium. What if your tenant will not pay you the rent on time, or they may default, non-payment? Clear? Suppose you rent an office to the startup, and if startup will run in a loss, they may delay the rent. Clear? So you change that higher expected return because of the risk and you charge extra credit premium. Then we have is the equity risk premium. Means why you need this extra return? Because real estate value fluctuates just like equity, so they can go up and down based on the demand and supply, interest rate, economy, vacancy levels, and location quality as well. So this fluctuation is nothing but it is equivalent to equity like risk. Clear? So you also need equity like premium for your real estate. Clear? And the liquidity premium, which I said that you cannot sell the asset quickly at a fair price. Clear? So real estate is not sold every day just like the share. Clear? Like if you'll take a flat now and you want to sell it, it can even take years to sell. Clear? Because it's very hard to find the buyer, provided if it's not in a very good location. If it's in a very good location, you can sell it in few days or few weeks. Clear? Now we have one more point. We have discussed it earlier many times in your level 1 and level 2 preparation about the REITs, that is your public real estate. Okay, for that liquidity risk is not that huge, they are highly liquid, so you can sell it on the stock market, you can buy it from the stock market. So liquidity risk premium is not there when I talk about the public real estate, that is the REITs, but it is high when you directly deal into the real estate. Clear? Now again you have to calculate the risk premium. So for that also we have a model, that is Singer and Terrar model. Clear? So before using the real estate written in advanced financial modeling like this, we need to adjust few of the aspect like smoothing effect. So real estate value does not change daily because price are not updated frequently. Clear? So their price generally look artificially stable. You won't find their price like this, like this, like this. No, they are more of a like this only, because once you get the price over here, then you will get the price over here, say after 20 years of that particular property, because it's not getting sold and purchased every day, so you are not able to identify. So the price is generally smooth. So what you need to do, you need to unsmoothen the price, you need to adjust the data to show the real volatility. Clear? Second is to add the liquidity premium. Since real estate is illiquid, so we must add this 2 to 4% premium to expected returns. So first point, remove the smoothing. Second, add liquidity premium. Clear? And the third one, consider the local nature of the real estate. Clear? Because real estate returns are not global, they depend heavily on the local economy, local demand, local zoning rules, and the local developments as well. Clear? So this is about the risk premium in the real estate. Now we have a small comparison between the public and the private real estate. Now, when I am looking at the public versus the private, clear? So, what is this private real estate? Means direct ownership. Wealthy people and institution, they diversify their portfolio by buying the flats, malls, offices, warehouses that needs huge amount of investments. Return appears stable due to the smoothing and the low short-term correlation with the equities. So basically, these are the some prime benefits of the private, or you can say the direct ownership. But when it comes to the REITs, okay, anyone can invest with a small amount. It's very highly liquid, anyone can buy or sell just like the shares. Short term returns move just like the equity market, and there is a high correlation with the stock, but over the long term the correlation with the direct property becomes higher when it comes to the risk. Clear? Now, generally, you will see that the return of the rates are higher as compared to the direct ownership, and the reason is high leverage. Okay, when there is a high amount of borrowing, then definitely the returns will seem spiked up. Clear? So, what you do, you need to make the returns deleverage, okay, or unleverage. Remove the effect of leverage from your return so that you can identify that what is the actual return, because REITs historically have shown higher returns and lower volatility than direct property investments. Clear? Because of the professional management and the liquidity premium is also captured. Clear? So if you'll ask me what is the difference across the real estate sector, so REITs are the one giving you the highest return and the second lowest volatility, because this retail malls have long lease and they have a stable cash flows. Clear? Retail REITs. But if I'll compare them with the industrial REITs, okay, like lowest return, highest volatility, because warehouse rent fluctuates with the business cycle. Clear? Retail REITs, industrial REITs, and coming to the direct real estate, apartments, they are the highest returns, offices, we have the lowest returns. Clear? These are the three different types of real estate: retail rates, industrial rates, and direct rates. Clear? Over here, I have mentioned it. Clear? Now, coming to the final point, that is your residential real estate. Residential real estate is the largest global real estate class, means 75% of the total value of the market is actually invested in the residential real estate. Clear? So long term real estate have outperformed the equity market, and I am saying it truly as a fact, inflation adjusted, with lower volatility than equity. Clear? But performance differs during the period. Like before the World War II, returns were very high. Post the war period, return becomes weak, but between 1950 and 1980, residential real estate performed very well and they have beaten the equity. Clear? But if you look at the period between 1918 to 2015, they have a very weak performance. But after 2020, after COVID, you will see again there is a boom in the real estate market. So after 2020, we have seen a boom in the real estate market globally. Clear? And there is one point, that diversification benefit. Clear? So residential estates, the real estate said, are across the country, they become uncorrelated, because when US housing moves up and down, India or Germany may not move similarly. So the correlation is very less of the real estate in multiple countries, but equity market become more correlated globally, and during the financial crisis they are highly correlated. So real estate is a strong diversifier even in a global portfolio. Clear? So with this, we have successfully completed our portion of the forecasting for the real estate. What we have covered up: the cycles, capitalization rate, risk premiums, difference between the public and private. Also, we have considered the residential real estate. Clear? I'm ending this lecture here. In the next lecture, we'll continue ahead with the exchange rate forecasting. Okay, thank you.